Welcome to the pre-opening edition of Storm Stock Solutions. I'm Grant Mercer. With the opening bell just ahead, the big story this morning is simple. Inflation is heating back up at the wholesale level, just as Washington locks in a new, more hawkish Federal Reserve chair. That combination is already rippling through commodities, the dollar, and expectations for interest rates. Let's start with today's key drivers. According to reporting from MarketWatch, wholesale prices jumped sharply at the end of last year. That producer price move is a reminder that the battle against inflation is not done, and it lands right as President Trump names Kevin Warsh to run the Fed. Warsh is well known as a critic of the central bank's post-crisis policies, and markets tend to see him as more comfortable with tighter policy and a stronger dollar than some of his predecessors. Put those together, and you've got a pre-market backdrop where traders are reassessing the path of rates. Higher wholesale prices can pressure margins if companies can't pass costs along, and a hawkish Fed chair tends to raise the bar for future cuts or stimulus. The focus on the street into the open will be, do bond yields push higher? And do we see more rotation between cyclical, inflation-sensitive names and longer duration growth stocks? That brings us to the opportunities and pockets of strength traders are watching. One of the most interesting threads this morning is what MarketWatch calls the Trump trade. That's returned about 29% in 6 months. Ned Davis Research built a strategy that leaned into miners and rare earth plays tied to the administration's policies, and those commodity and resource names have been the engine of that outperformance. Now, even the authors are saying it's time for a big change in that positioning. That kind of shift can open the door for active traders looking at where capital might rotate next, whether it's from miners into broader cyclicals or from policy-sensitive baskets back toward more traditional sector leadership. You can also see the real economy strength in some of the single-name stories. American Express is highlighting strong travel and luxury spending, with affluent cardholders enjoying life and getting ready to hit the road again. That's a quiet endorsement of the high-end consumer, which tends to support travel, leisure, and parts of the services sector when it shows up in card data. On the flip side, there are some very clear areas to handle with care this morning. Precious metals are front and center. MarketWatch's Barbara Kallmeyer notes that gold's searing run has been halted, with silver even briefly dropping below that eye-catching $1 level, as the dollar rallies on expectations that Warsh takes the Fed chair. A stronger dollar and a more hawkish central bank are classic headwinds for the dollar debasement trade that's fueled a lot of the move in gold, silver, and copper. For traders leaning heavily on that narrative, this is a shot across the bow. The question now is whether this is a quick shakeout after a big run, or the start of a more sustained unwind in the metals complex. Energy is another space worth close attention. Exxon and Chevron just reported earnings, and as MarketWatch points out, they're pumping record amounts of oil, but lower crude prices dragged on profits. That's a reminder that even operational strength and production growth don't fully insulate the majors when commodity prices soften. For the broader market, this feeds into a bigger question. Are we in a range-bound environment for crude where volumes matter more, or are prices at risk of another leg down that could pressure energy equities more broadly? Now, let's talk about some under-the-radar setups, names and themes to keep on a watch list, rather than treating them as recommendations. SoFi shares are on the move after the company hit a revenue milestone, with home loan originations nearly doubling in the latest quarter, according to Emily Berry's reporting. That's an interesting intersection of fintech, housing, and consumer credit. If rates are perceived to be heading higher under a Warsh Fed, traders will be watching whether that surge in originations is sustainable, or if it proves to be a pull forward. Another quieter but valuable story comes from Mark Hulbert on growth versus value. He highlights that investors often read too much into short-term style performance and make sweeping assumptions about which one has to outperform next. In a tape where macro factors like inflation and Fed leadership can cause sharp rotations, that's a timely reminder. Style and sector moves can be noisy over days and weeks, even if the headlines make them feel structural. Stepping back to the macro, the through line into the open is this: higher wholesale inflation, a newly named Fed chair with a reputation for skepticism about easy policy, and an immediate impact in the dollar and metals. Bond markets and rate-sensitive sectors are going to be the pressure points to watch. Traders will be asking, does this announcement reset the entire conversation around how quickly the Fed might cut in the future? Or is it more of a fine-tuning of what was already priced in? As we head toward the bell, keep an eye on three things: the reaction in precious metals and the dollar, rotation out of or into that Trump trade basket of miners and rare earths, and how rate-sensitive names, From fintechs like SoFi to housing-adjacent plays, trade as the new Fed narrative beds in. I'll be back with intraday updates once the market gets going to see how this all settles out on the screens. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer.